Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita, Khemka, and my colleague.
Hello there, I'm Yatin Motas.
Well, Yatin, seems like we picked up from where we left off.
Yeah.
Last week, the holiday shortened week was a fairly good one, given the fact that we saw 4.5% kind of an up move on a weekly basis, and we've just picked up from there another 1%, add to that, and we are above that 24,100 mark as well. We've reclaimed 24,000 for the first time since January. So yes, a 3-month high for the market, but the toast for the market today was the Nifty Bank index.
Truly, all-time high.
Of course, all-time highs 55,461. That's the new 52-week high or all-time high that the Nifty Bank has clocked. In fact, good numbers, strong numbers from the likes of ICICI Bank, HDFC Bank, Yes Bank, all of that propelled the Nifty Bank index to its lifetime highs. But surprisingly, the Nifty IT pack was also buoyant today. I think 2.5% gain on the Nifty IT pack, and this despite disappointing numbers from Infosys. We'll discuss that in details. But Street cheered the fact that the IT major has come out with a guidance. There were expectations or fears that it may not do so in the wake of the uncertain global environment, but it did so, and of course Street clearly cheered that. All the IT names were buoyant in trade, led by Tech Mahindra. But if you look at the other pockets, all of them did well aside of the Nifty FMCG pack. That was the only pocket that wasn't in the green today, but barring the FMCG pack, all the sectors were buoyant. Even Realty pack was up in excess of 2%. Oil and gas was upbeat. The Nifty PSU bank index was also participating. And if you look at the broader end of the markets, 2.5% gain on the Nifty Midcap index as well. Breadth, of course, was skewed in favor of gainers. Strong breadth. And if you look at the gainers, as I mentioned, Tech Mahindra are leading the pack. Trent, IndusInd Bank, Hero MotoCorp, Power Grid, these were just some of the gainers that we saw. The list of gainers is long today. Even the likes of M&M, HCL Tech, Bajaj Auto, Axis Bank, JSW Steel, all of them up and about. But what didn't do well, some of the FMCG names, ITC, HUL, Nestle, Asian Paints, these were some of the laggards. Some of the pharma names like Sun Pharma were also under pressure. Cipla, under pressure. Adani Ports, that was the top Nifty laggard, but losses were anywhere between 1 to 1.5%.
Yes.
No big cuts on any of these stocks. But Yatin, broader end of the markets had quite a few high flyers. But let's talk about Eternal first. It has, it is looking to cap its foreign holding at 49.5%.
Yes. So Eternal, which is Zomato, clearly in focus, because we have seen that the dark stores wherein Zomato is currently dependent on third parties now will be able to manage itself as per the FDI regulation. So this is much required from their end to remain an Indian company, so that they can be in compliance when it comes to retailing of goods and services via their owned dark stores. Now this capping would probably mean that the weightage in the MSCI index and the FTSE index would reduce substantially, translating into a $600 million selling from the MSCI participants, as well as a similar kind of a selling could be there in FTSE, but in phases. So almost a $1.25 billion selling expected in Zomato once this thing comes into effect. How does it really impact the stock? Obviously, there is paper supply of the tune of 10-12,000 crores. But on the other hand, earnings wise, probably the 1-2%, 3% kind of a EBITDA margin uptick could be seen once they start owning those dark stores. So yes, the stock saw some bit of downtick in the opening hour of trade, but then because of the market buoyancy, the stock managed to recover. But from Zomato, talking about the markets, Nandita, clearly on a tear. Advanced decline ratio better than 4:1. Midcap indices gaining nearly 2.5% each. So good moves coming in for midcaps. Just Dial, Tata Elxsi, post the numbers, saw a 9-10% kind of up move. We had Suzlon, Techno Electric, K Fintech also bouncing in trade. What was not doing well is the likes of Marico, RK Forging, DB Realty. The ones which moved last week or probably during the month saw some profit taking. But look at stocks like Aavas, BSE, Bharti Hexa, Bharti Airtel, Bajaj Finserv. All of those stocks are at multi-year high. So clearly there is momentum in stock specific names with Aavas, BSE, Chola Finance kind of a stock clearly making a move in today's market.
That's true, but as I mentioned at the start, Yatin, the toast of the town is really the banking pack, right? And especially the likes of ICICI Bank and HDFC Bank. Both the banks are, or stocks are actually at life highs, right?
Yes.
And of course, numbers have been fairly good. This despite the fact that, of course, we've seen 2 rate cuts from the RBI,
True.
although some brokerages believe that margin pressure will be there. But let's not forget that the banks have also cut fixed deposit rates, right? So that would provide some cushion to margins going forward. But let's look at what the street really has made of the numbers and what are the calls and targets on some of these stocks, HDFC Bank and ICICI Bank, and which one is a better bet. That's the key question
Correct,
that you end up asking experts. So we'll talk about that, but quickly taking you through the numbers for HDFC Bank. Profit rose somewhere around 7% on a YY basis. Asset quality has improved. Provisions are down significantly on a year-on-year basis, up slightly on a quarter-on-quarter basis. The best part is that margins, on total assets is at 3.54%, which is at a 7-quarter high. The core net interest margin is also at somewhere around 3.5%. The credit to deposit ratio, that was a pain point at 104%, has now declined to 96.5%. That's another positive. And now if you take a look at what the brokerages have really said, they've all maintained their buy and outperform calls. So target prices have also been jacked up quite significantly, right? The highest target price on HDFC Bank on the street is from BNP Paribas at 26.60, signals an upside of over 20%. But Jefferies per se has a target of 23.40. It has said that the deposit growth has been healthy. Management has also said that it expects deposit growth to pick up going forward. And the loan to deposit ratio correction is something that brokerages have cheered. In fact, Jefferies said that it is setting the stage for stronger credit growth over FY26 to FY27 for the bank. Also, the cross-sell potential and stable credit costs will support core profit growth going forward. However, it has cautioned that rate cuts may temporarily, drag margins going forward. CLSA outperform call target price at 2,200 rupees. CLSA is expecting somewhere around 75 basis point cumulative rate cut by the RBI, and which is why it has trimmed its FY26 to FY27 PAT estimate for HDFC Bank by 2 to 3%. Macquarie as well outperform call target price at 2,300. It sees the potential for improvement in the return on asset via margin expansion going forward. Aside of that, lastly, Nuvama is saying that it has a buy call target price is sub 2,200, just 2,195 or so. And it is also impressed by the core NIM beat and lower slippages for the bank. Let's talk about ICICI Bank. Here, profit up 18%, NII growth in double digits 11%. Asset quality was pristine. For both the banks, asset quality has been pristine. And return on assets is also improved on a quarter-on-quarter basis. And so has the cost to income ratio. Even slippages or slippage rate was lower on a sequential basis. The only drawback in a spick and span quarter was the loan growth. It has been a little softer than what was being anticipated. But despite that, of course, major brokerages have kept their faith, outperform calls. CLSA, Macquarie both have outperform calls. Target prices range anywhere between 1,670 to 1,700 rupees per share. Also, CLSA has noted that the OPEX has been lower and slippage ratio for ICICI Bank has also improved. Nomura has a buy call. Target price is at 1,690. They've also said that they are maintaining their bullish view on the bank because of the sector leading execution. They've also cut their FY26, FY27 EPS estimate by 3 to 5%, given the fact that they are factoring in a 125 basis point repo rate cut by the RBI. But Jefferies has the highest target on the street for ICICI Bank, somewhere around 1,710, which implies an over 20% upside. They've also trimmed their EPS estimates for FY26, FY27 by 5% to account for timing gap. But, some experts I was listening to on CNBC TV 18, just caught my attention. Digant Haria of Green Edge Wealth Services was saying that ICICI Bank, earnings performance has been to the T, wherein HDFC Bank coming off a merger, at one point it used to report growth of 18-20% on a regular basis. But now it is yet to go back to those glory days, wherein ICICI Bank is at peak performance. So in that sense, he said that it makes sense that, investors should look at an HDFC Bank, switch to an HDFC Bank for higher upside. But, all in all, both the banks have reported strong set of numbers, and for ICICI Bank in particular, it doesn't have a single sell call by any of the brokerages that cover the stocks.
In fact, most of the brokerages we saw, have a 15-20% upside for both ICICI Bank and HDFC Bank. But more targets are aggressive on HDFC Bank. ICICI Bank, obviously, for the last 12 months has been outperforming, as a large cap stock as well as a bank stock. Clearly is witnessing some profit taking after a 7% move, which came in recently for both HDFC Bank and ICICI Bank just in a week's time. But what was buzzing today was the stock of Gail. Now, this gas company has seen a 5% uptick today after CLSA has upgraded the stock. Why the upgrade? Because PNGRB, which is the regulator for gas and gas transmission lines, has put up a consultation paper. Obviously, the consultation paper would mean that if this consultation paper is approved or probably appreciated by the consulting which is going on, the tariff of gas pipelines owned by Gail would go up by 18 to 20%. Obviously, the tariff decision is expected somewhere in June, probably 2-3 months from here, and every 10% hike in tariffs would mean 10% higher profits for Gail, according to analysts. CLSA has upgraded their target from 175 to 210. They have a buy rating on the counter. They have increased the EPS estimates by nearly 19% for FY27, factoring in higher tariff transmissions for Gail at this period. We also have, Morgan Stanley, which has a buy rating with a target of 248. They also believe that there could be 20% upside risk to the estimates when it comes to the EPS, because once the tariff for transmission lines goes up, Gail's profit would improve disproportionately. So, on the hope of a tariff order, which could be favorable in the month of June, probably the stock of Gail saw a rally of nearly 5-7% intraday, almost at the day's high. But yes, intraday went as high as 6.5-7%, settling the day at nearly 5% plus.
Okay, Gail, and in recent times the stock has seen good traction. I think in the last 1 month it has gained somewhere around 11%, and also once this tariff revision comes about, I think it will be applicable from the 1st of January 2025 from a retrospective effect, and that analysts believe will lead to significant earnings growth and will be a turning point, so to say, for the stock as such. But another pocket that was in focus today was the IT pack. Thursday when we ended the week and we saw the numbers, we were really scared. We were thinking that we will see some dire reaction on the stock, but don't forget, a lot of price damage has already been done, for some of these IT names, especially the likes of Infosys that have seen a 25% cut on a YTD basis. But given the fact that there were fears that in the wake of the tariff uncertainty, the IT major may not really come out with guidance. So that hasn't really happened, and they have come out with a guidance which was below what the street was expecting. But nevertheless, the guidance, the fact that the company has come out with a guidance in such an uncertain environment, really found favor with the street. 0 to 3%, that's the FY26 revenue guidance that they have given, which analysts believe that the lower end bakes in the most pessimistic scenario, and the upper end, looks fairly optimistic in this kind of an environment. But in terms of the street verdict, there have been target cuts yes, but it still remains as a top pick within the IT basket for most of these analysts. Looking at the constant currency revenue, that the company handed in for Q4, it declined 3.5%. In fact, if you look at the FY25 constant currency revenue growth, it was at 4.2%, which was below the guided band of 4.5 to 5%. And in terms of FY26 margin guidance, it is in the range of 20 to 22%. Of course, in terms of the environment, if you look at what all the companies have done, they've all been cautiously optimistic, or rather cautious, so to say, on the deal environment is uncertain. But TCS managed to hand in record, deal wins in the fourth quarter, and they've also said that CY25 will be better than CY24. For Infosys, they have, of course, said that there is a slowdown in client spending on large deals, but there has been no ram downs or cancellations as such, barring Wipro that said that one large transformation deal was paused. I think all the other companies have said that there has been slowdown, yes, but no major ram downs or cancellations have happened. So in terms of the brokerage verdict, then most of the brokerages have maintained their buy calls on the stock, starting with HSBC. Target, although by HSBC, has been cut to 1700 rupees, and they've noted the fact that a guidance for FY26 in this environment is quite optimistic, although fourth quarter was a sharp miss in terms of revenues. They've said that margins are manageable in the near term, and some of the brokerages have said that margin wise the company did well. The rupee movement will be key to watch according to HSBC. JP Morgan also has an overweight rating. Target price is at 1800 rupees. They said that the new guided range is largely de-risked, and the multiples, PE multiples are back at 10 to 20 year averages, but they have trimmed their earnings estimates by 2 to 3%. Wherein Citi is concerned, they have a neutral rating. Target price is a tad lower at 1525, they've said that they've pointed out that the higher end of the guidance looks aggressive in this environment. They've trimmed their FY26, FY27 EPS estimates by 2 to 3%. Jefferies, on the other hand, again buy call here, target price at 1660. They've said that, of course, the revenue decline was the key negative surprise. In terms of the estimates, earnings estimates, they have trimmed it by 2 to 3%, and they expect Infosys to deliver around 9% EPS compounded annual growth rate over FY25 to FY27. Lastly, Bernstein has an outperformed call in target price of 1700 or 1680 actually. They have said that the weak exit rate from FY25, of course the 4.2% CC revenue growth in FY25 makes achieving the upper end of the guidance challenging. But they have also said that the stock is down 25% on a YTD basis, which is why they are constructive, because they would look to accumulate on further price correction. So yes, all in all, Yatin, for all these IT majors, we've seen EPS cuts of somewhere around 2 to 3%, because I think the kind of price damage that some of these IT stocks have already seen, it bakes in the current, the nature of the environment in terms of tariff and what's happening in terms of discretionary spending as well. So brokerages have maintained their faith in Infosys, and which is what we saw play out in today's session.
Yes, and the IT index was down nearly 25% after last 1 or 2 days of rally. In the IT stocks, we have seen that index still down 20%. So yes, probably everything is in the price, and at the current market price, we have the dividend yield, which is almost between 3 to 5% according to what you estimate. So I think that is also valuation support. And the pricing in has already happened, over the last 2 to 3 months. We have seen the IT index correct sharply, ever since Trump has been talking about his tariff tantrum. So, yes, the uncertainty is there, but probably in the price, and hence some bit of short covering and fresh buying in trade today. Almost 2.5% higher for Infosys in trade today, despite the fact that the earnings have been quite weak.
That's true, Yatin. Let me also point out that after 2 weeks of truncated trades, we are looking at a full week, a 5-day week, and lots of earnings to watch out for this week as well, as we get into the thick of the fourth quarter earnings season. So HCL Tech Mahindra, yet to report earnings this week. You have Axis Bank, Maruti, HUL, SBI Life, all these numbers. We will be, of course, watching out throughout the week, but nothing to complain. We've started the week on a fairly good note, magical Monday, so to say, since we are looking for words matching with the days. So yes, let's hope that the momentum continues, and of course, we will be bringing you fresh updates each day. So don't forget to tune in tomorrow at 9 a.m. on Opening Bell. But for now, it's a goodbye from me and Yatin. Thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates.